Welcome. I'm Dan Rahill, Managing Director with Wintrust Wealth Services and past Chairman of the Illinois CPA Society. At the Society, we put together this series of 8 short videos on the CARES Act. This is our 7th in our series, and today we're going to be talking about retirement and employee benefit plan provisions. So let's just jump right in. The CARES Act suspends required minimum distributions, or RMDs, for 2020 for retirement plans like IRAs, 401ks, and 403bs. If you would otherwise be required to take an RMD from a retirement plan in 2020, that requirement is waived this year. You do not need to take the distribution. For those individuals who turned 70 and a half last year and chose to defer their first payment to April 1, 2020, you're in luck. You're no longer required to take that first payment this year or your regular 2020 distribution. Now, what happens if you've already taken your 2020 distribution? As long as you're not dealing with an inherited retirement IRA plan, if fewer than 60 days have passed since the distribution, you can roll back the distribution plan into the account it came from or another eligible retirement account, particularly if you have not previously rolled over a distribution or you did not take your 2020 distribution in installments. This rollover option allows you to reverse the distribution and proceed as though you never received it, although it's slightly trickier if taxes were withheld on the distribution. But what if your required distribution you already received came from an inherited IRA? Well, you're kind of stuck on that one because with very few exceptions, under this scenario, you can't do it. There's no way it can be undone and rolled back into the plan. Early withdrawals from your retirement account. Will there be a penalty? For individuals qualifying for coronavirus-related distributions, which are defined in a minute, the 10% early withdrawal penalty is waived for distributions up to $100,000 in 2020. The taxable income from such distributions can be included in income ratably over a 3-year period, and a taxpayer may recontribute to an eligible retirement plan within the 3 years without regard to the annual cap. Borrowing limits from a retirement plan. The maximum amount of loans when combined with existing loans, which can be taken from retirement accounts, is the lesser of $100,000 or 100% of a participant's accrued benefit up to 50%. That's an increase from $50,000 previously. The repayment of these loans may be delayed for up to 1 year, and this change will be in effect through 2020. Now, who qualifies for these benefits? To qualify for the coronavirus-related distribution benefits described, the affected participant or IRA owner, including a spouse or dependent, would need to either be diagnosed with SARS, COVID-19, or experience adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, being unable to work because of lack of childcare, reduced hours of a business owner or operating individual due to the coronavirus pandemic, or any other factors as determined by the Treasury Secretary. And finally, the April 15th deadline is now passed. Can you still contribute to your regular or Roth IRA? Well, the Internal Revenue Service and the Treasury Department extended key tax deadlines for both individuals and businesses to July 15th, 2020 to pay and file federal income taxes originally due on April 15th. No late filing penalties or late payment penalties or interest will be due. Individuals, trusts and estates, corporations, and other non-corporate tax filers can qualify for this extra time to file and make payments. Both regular and Roth IRAs, and health savings account contribution deadlines were extended to July 15th as well. And with that, we finished our employee benefit plan provisions in the CARES Act. Please stay tuned for our 8th episode where we're going to be talking about Code Section 139. Thank you.